Welcome to the KP Podcast, where we talk about the business of real estate. A podcast about leveraging opportunities, growing your business, and experiencing financial freedom. Here are your hosts, Keith Anderson and Peter Cambukos.
Hey everybody, welcome back to the KP Podcast. We're coming to you from the Forum. I'm Pete, going without Keith today, but we have got a special guest today, a good friend, Justin Mirche, who is the owner and CEO of Creative Credit Solutions. And so we're going to get into a little bit about the credit stuff today, guys, which I know in our world, in real estate, so we're dealing with our clients, the investors out there. This is something obviously we deal with every single day. So it's nice to have someone like Justin on the podcast who can talk a little more to it. And then we will get into a little bit at the end here about the economy and markets and what's going on in general. But Justin, welcome to the show. Glad to have you.
Thank you so much. I'm very excited to be here.
Yeah, dude, it's awesome. And so everybody out there knows I've known Justin, for a while now, probably a little bit over a year and a half, I guess it's been so when we first met, and I've personally worked with Justin. But for those out there that don't know Justin and what he does, Justin, let's start a little bit with just your background and kind of let people know, who you are, where you're coming from, where you're at now, and just a little on that backstory.
Yeah, sure. So my company, I've got a couple of different companies, but the credit company on the consumer side, what we do there is we try to help consumers with their personal credit, predominantly in the mortgage industry. So mostly we work with realtors and lenders. And if you're a realtor or lender out there, you know that the mortgage score is quite a bit different than any score the consumer is going to see on the open market, right? They're usually going to think their scores are better than what they are. And there's good reason for that. So, with my company, we'll take the client in and we'll do a full credit analysis and determine what needs to happen in order to get them to qualification. For many clients, it's usually a plethora of things. Sometimes the client has, had their life situation. They're on the other side of that. Yeah. And they kind of blew out their credit, right? And they need to be kind of reestablish credit. So there's trade lines and things like that for them to help them reestablish credit. In some cases, we need to restructure debt. They've got some issues with the way that their debt is structured. Just specifically what I see a lot is student loans, where the mortgage score is actually like the way it's structured, and just restructuring it can pop up our scores. In some cases, there's marks on their credit profile that doesn't meet the legal requirements to be there. My company, I'd like to say that we're one of the best in the business when it comes to finding these inaccuracies and errors and unverifiable items that are on their credit profile. So in many cases, we can get items off of a person's credit profile just because it doesn't have the legal merit to be there in the first place. Wow. And then in some cases, we do need to settle items in order to get things removed and grow scores. So really it depends on the client. I had my team reached out to me today, and we had a person that, they were talking to, and they wanted to know, without a credit report, what it is that you can do in 1 month's time.
And you said,
let's look at your credit and we can have that discussion. But usually 1 month's time in the credit world is not much. Wow. Not much time.
Yeah.
Something can be done.
I was going to say, you didn't pull out your crystal ball and your magic wand and you're like, hey, let's see what we can do here in the next 3 weeks. Yeah.
You tell me what's on your report and then I'll tell you what we can do. It doesn't work that way. I wish it was. I wish it did work.
And there's a lot that I want to get into right there, Justin. But I think just that last point that you made, one of the things that I really appreciate about you guys and is a little bit different, I think, with you and your company than in the industry is, you guys are honest and transparent, because I've been in this business, in the real estate business now, 19, almost 20 years. And so we've dealt with people in the credit business, in the credit world, and a lot of them will promise stuff, or you'll get the low cost, hey, just get on our monthly plan, and you're on there for 6 months and nothing happens. Or get the other side where they promise you the world. Oh yeah, we'll get you up to 800 credit score in the next 60 days, no problem. And then
right.
And then so you've got that sort of thing. So, definitely you guys do things different. So that's part of why I want to have you in particular on here today. And when you were going through all the things that you guys do, it sounds like you're taking a little bit of a different approach, more of a comprehensive approach. So you talked about actually the potential to restructure debt. Obviously the common things that people know is get inaccuracies off of there, or some of the other, the other things that you talked about. So what are some of those most common things that you're seeing on there? Number one, and kind of, I guess, what is the, I don't want to say typical, but I guess again, common, like what are the most common things that you're not only seeing, but tactics that you guys are taking, or common things that people are running into there?
Right. It depends on what aspect you're looking at. So as I had alluded to before, when it comes to restructuring debt, the biggest thing that I see for mortgages, right, for mortgage lenders, is that you're going to see that somebody went to school, they have 10 or 15 different student loans. Those student loans have been on deferment or some kind of income-based repayment plan. So essentially you have 15 different loans that are shown that you took it out for a certain amount, but you owe significantly more. Now, the mortgage score, it's an algorithm that's been around for over 20 years and hasn't changed since inception. It tags all of those different installment accounts as being overutilized, as being not managed properly, essentially. Now, it's kind of unfair. The newer algorithms, when it comes to FICO 8, FICO 9, and FICO 10, have recognized that student loans come in multiple accounts, but the mortgage score doesn't realize that. So what we do for those is we'll just have the client, we'll guide the client to have them restructure it, depending upon, some metrics, but usually being able to consolidate it so that we have either one or two student loans, subsidized and unsubsidized in most cases, or it shows the client took it out for X dollars and they owe X dollars instead of 15 accounts that are all upside down, right? The mortgage score responds very favorably to that, and there's some other examples with restructuring, debt that can be very helpful on a client. The mortgage score is very responsive to paying off credit cards. So if we've got a client that has decent scores and they're overutilized on their credit cards, sometimes getting an installment loan in place of that, and clearing out their credit cards will spike up their score in a very big way, which is kind of funny because you would think if you take, as an example, $100,000 worth of debt that's on your credit cards and you just move it over to an installment loan, you would think that wouldn't be a huge impact. But for the mortgage score, it's gigantic. You get penalized very little for the installment loan, and you get a huge increase for clearing out your credit cards. So again, the mortgage score, most who realize this, is a very old algorithm. And in the last 20 years, I would say there's a lot that's been changed, right? But in the mortgage industry, it's not the scoring algorithm. It's the same.
They're still playing with that dinosaur there. So
they are.
That's super interesting though that you said, because even that's something I hadn't thought about. So the same amount of debt, on the credit report. So that situation hasn't changed. Maybe going to the installment loan, you would think they're getting a lower interest rate, so maybe consolidating that payment's going to help a little bit. But you still got, in that example, $100,000 worth of debt. But to think, knowing something like that is something, like I said, even I wouldn't have necessarily thought, hey, that's going to make any kind of impact on my credit score necessarily. So that's interesting. That's stuff I think a lot of people probably don't know, certainly, and certainly don't think about. But it sounds like you said you've got this mortgage score, and that algorithm's been around for a long time. And you haven't really seen, like I said, we've seen all kinds of changes happening in the industry, but nothing on that front. Do you see anything? Is there anything in the works? Anything that's coming up? Anything, on the horizon there that people are either discussing or that we're seeing possibly to be implemented on those? Because and just to follow up, tag on to that, I guess, we hear about, I think it was Bank of America, for example, several months back, we talked about, hey, we're going to look at, some of these for kind of lower income or first time home buyers, and we're going to score these things differently. And it seems like that was kind of a company specific, deal for them. But is there something larger, on the horizon there with changes?
Kind of is. I mean, so there's a couple of different things. Okay, so first of all, when it comes to the different industries, there's multiple, scoring algorithms, but then within the industries, there's different scoring algorithms they use that are called industry specific scores, right? So for your auto loan industry and For your bank card industry, there's multiple different algorithms they use. So there's competition. In the mortgage industry, there's no competition. It's FICO 2, 4, and 5. They've been using it forever. That's what they use. So technically, it as much as I like FICO, somewhat obsessed with the company, they do a great job. It is a monopoly, right? And monopolies aren't good, right? In any case. So there's been a lot of lobbying power, a lot of people trying to make some changes that say, hey, wait a minute, you can't have a monopoly only. There should be a competing scoring algorithm. So that's been going on for years. Last year, there was some legislation that was passed that is going to allow a competing mortgage score, which is, in the works as we speak. And that competition is actually going to be Vantage Score, which is going to be your Credit Karma, so your Credit Sesame score, all the free scores you can get on the market.
Yeah.
That is Vantage Score, right? Vantage it's not a bad algorithm. It works similarly to FICO. My biggest issue that I have with it is that it was created many, many years ago as a way to compete with FICO, but it was created by the 3 credit bureaus. So Vantage Score is actually the 3 credit bureaus. So they want to manage the flow of information. They want to manage the personal information and sell it, but they also don't want to pay FICO for scores anymore. So they created their own company, and, they created a scoring algorithm called, Vantage Score. So all this lobbying power and billions of dollars and money, they finally pushed their agenda far enough to say, hey, so they give away the score free to everybody. Banks use them. Capital One, as an example, uses Credit Sesame, the Vantage Score. Right. But what's interesting about that is that, if you go to apply for Capital One, they're going to use a FICO score to qualify you. They're going to highlight the free score. So the credit bureaus, not much on conspiracy, but it, kind of is what it is. They're giving away the score to everybody. They've got lots of lobbying power and money. So they finally pushed their agenda. There is going to be a competing score. When that's going to come through, I don't know that, they'd have to change all the systems,
right?
For FHA and for and all,
yeah, and
US, all that. So
right, and I would imagine that there would have to be some sort of push from FHFA or Fannie or somebody on the back end to want to pull that score. And so even though that it sounds like that legislation's gone through, we're still going to need for to see it on the front end. Where the lenders and the secondary market is saying, yes, we're accepting those. And so as far as that goes, we don't really have any visibility at this point on timelines or anyone saying, hey, we're going to start using those, next year or something like that.
No, it's coming, though. I mean, it's going to be tricky, though, because, they've got some points, right? It's a monopoly. FICO's got a monopoly. FICO has some pretty stringent requirements to even pull a score. You've got to have an account for 6 months, as opposed to Vantage Score where, you can pull a score from day one. Self-reported is pretty common on Vantage Score. So their idea is, hey, FICO's a monopoly. And also it limits a large portion of underserved people from ever even getting a mortgage, right? So, they're not wrong on all of that. But, knowing that it's the credit bureaus that are pushing their agenda, I'm like, okay, you're not wrong. But, on the same note, do we really want the credit bureaus managing the scores and the data? I'm not a fan of the credit bureaus. So, I would say no. And then kind of, looking at it from just kind of practical standpoint, you go to a lender and they pull a FICO 2, 4, and 5 mortgage score. You don't like that, so you go to a different lender that pulls a Vantage Score. Didn't qualify here, qualified there. Or maybe the same lender can pull either score.
Yeah.
So you can credit score shop to determine what rate you are going to get, so I don't know how that's going to work. Like, how does that even?
That's going to be interesting. And it would seem like at the beginning, it could be used as a competitive advantage. Hey guys, we know the Vantage Scores has to be a little higher. And over here at ABC Lending, we use that one. So come on over. So yeah, that'll be interesting to see. But to your point, FICO's got that monopoly. It's going to be good. Yeah, it would have been better if it wasn't the credit bureaus, but I guess, something's better than nothing there. So we'll see what comes of it. And having done this now, Justin, well, I guess let me back up there. How long have you been, in the credit world? How did you get started in this, and how long have you been at this game?
Yeah, so that's a great question. So I graduated from school. I have a degree in finance. Always kind of, I've always been the finance credit person in my circles, really. I was the go-to person for friends and family, and, just kind of that guy. And I was working for a software company, and I was, an executive salesperson. So I was, gone all the time from my family. And I think I was on a call with a friend, maybe it was a family member, I don't know. And I was talking to them about their credit. My wife said, "Why don't you do something in the credit world? This is really your passion. This is what you love. Why don't you go do that?" Now, I love the software industry. I loved it. I was just gone all the time.
Yeah.
There was no, it's hard being gone half the week or every week, half the week, flying, it's old very quickly. So really she was like, "Why don't you kind of figure out how to do that?" And I was like, "You know what? That's not a bad idea." So I did my research, and for a year while I was working at the software company, I was doing pro bono work for lenders, trying to figure out how I could make this work. And that's, when I realized the light bulb came on, I was like, wow, this is going to be good. Because we were getting some pretty dramatic results, and I had never worked for a credit company, so I didn't know that we were going to be high end. I just did business the way that I thought, you should do business. Right. I didn't realize until I got further into the industry what a nasty industry it is. In fact, I was a little bit embarrassed to be associated with it at first. I was kind of, I wouldn't tell people what I did. I wouldn't.
You don't want the reputation that goes along.
Yeah, they're like, "Whoa, you're one of just this weird kind of stigma that went with it."
Sure.
But what's fun though about that is that it wasn't. What I realized early on was that because most of the industry is like that, getting in good with the right lenders and all of that, they immediately see a difference. When you talk to them. Which I didn't know either, right? I didn't know what I was doing, right? I had no idea, but I had picked up some pretty big accounts right up front from some of the pro bono work that I did. And then ultimately I got into some branches, and those branches put me into other branches, and then, so what I tell people is, that are, concerned about the industry these days, is I say, there's good companies out there. They're just hard to find in the mess of what's out there, right? But I can tell you that if a lender is going to refer you to a company, they're not going to put their name on the line and lose the realtor who just sent them that business unless they have confidence in the company, right? Does that mean that it's all going to be perfect and, 7.3 days later, you're going to have a 9,000 credit score? That's not a thing, but 800, so people understand.
Yeah.
It doesn't work that way either. It takes, considerably more time for the most part, right, than, a week or two.
Yeah. No, and that's a very good point. And one of the things I always tell people, when we refer people to you and your company is, hey guys, Justin and his people are going to be really honest with you about, yes, some of this stuff is easy to get rid of because it's inaccurate, there's issue, whatever. Some of this stuff might be harder. I can't promise you this. It's going to, we're looking at the time frames as opposed to just promising the world and just saying, hey, yeah, no problem. We'll fix this in no time and everything's going to be great. And the difference is, like I said, not only you guys up front with setting those expectations, some big we talk about in our own business, but then delivering, and then getting those results. And so along those same lines, is there some common, myths or misconceptions that you run across a lot? When you're talking to clients, is there something both on the good or the bad side that you hear, more often than some others that people have wrong out there?
Absolutely. I hear about stuff all the time, and you just got to get on TikTok or Facebook or YouTube.
I can imagine what's happening on TikTok with some of this stuff.
Oh, it's crazy. People are always telling me, this is what I heard on TikTok. Is it true? I'm like, no, that's not the way it works. And what's so interesting is that, credit can be pretty boring and not very glamorous. People want you to tell them stuff that is over the top, but they want so desperately to be oversold, so desperately in many cases. And you're like, I'm so sorry, but it just doesn't work that way.
And they're like, Justin, what's the magic trick? I need the magic trick.
There is no magic trick. It's elbow grease is what it is, right? I mean, it's elbow grease. So, and being able to predict outcomes, we're good at what we do, but, it doesn't, we can't predict what another company is going to decide for that client, right? We know the right things to do. We understand how things work. But it doesn't mean that, we can wave a magic wand and it all kind of get better. So they come to us with all kinds of crazy things. Like this one recently from last week kind of sticks out in my head. A guy came to me and said that he was going to go get a Chase card. And then if he got a secured card and he did well with that for 6 months, and I'm kind of abbreviating here, that he'd get like a $250,000 limit from Chase. And his credit was really, really bad. Like he wasn't even going to get approved with Chase. Chase wouldn't even deal with that, right? Because Chase only deals with kind of your upper stuff.
Sure.
Well, then I said, so where did you hear that from? And, somebody I work with told me, this is what happened with them. And I'm like, So I'd really love to see documentation on that.
Yeah,
because I deal with Chase. And, I know how Chase is. They only deal with, your upper stuff. And also just from a business perspective, if you've got poor credit, getting very high limits, especially in the 200,000s is not doable. So I hear people coming to me with all these things. And when I debunk what they tell me, sometimes it gets a bad response. So I told him, I said, listen, here's what I want you to do. I want you to go run with what you're going to do, because he was going to meet with Chase the next day. I said, I'm not trying to be Debbie Downer, but you're going to get denied. So when you get denied, let me know tomorrow. We'll have another discussion. And the next day, he texted me back, yeah, I got denied with Chase. I was like,
You're like, that's a surprise.
Come in.
Yeah.
So TikTok and, all these things, they feed these consumers with all this nonsense. And then when there is a bit of truth, a lot of times it doesn't apply to the mortgage score, because the mortgage score is 20 years old and it works differently than your newer algorithms.
Yeah. Yeah. And that's a shame, because, we hear and see, similar things, obviously not nearly as much as you do on your end in talking to them specifically about their credit, but it's unfortunate because there's a lot of, bad information out there. And a lot of times you have good people that think they're doing the right thing and don't. And so, again, to that point, is there, for folks out there who are looking to just in general say, hey, are there things I can try to do, to put myself in a better position and kind of help things overall, and just, I guess, kind of rules of thumb, like one of the ones I heard, and I don't even know, I guess, if this is true, but early on is, hey, don't get like the store credit cards. If you go to Best Buy, you get that credit card, that's not looked at as favorable as if you get the Chase card, so stay away from those. So are there like general suggestions or rules of thumbs for people out there to know about?
Sure. Now, it really depends on where they're on the spectrum, right? If you're a brand new credit profile, like my daughter, she's going to be 21 years old this year. She's a brand new credit profile. Getting a credit card on her credit is important, right? And then I was able to add her to one of my high limit credit cards just to kind of show that she has 10, 12, 15 years of history, and perfect, credit history. So I was as of her credit profile very, very quickly, and then she's getting, I think her Wells Fargo card just went up to like $4,000, for her, which is a really big deal.
Yeah. For a 21-year-old. Yeah.
Yeah. So if you've got a brand new credit profile, getting your credit established is what's going to be important. Now, if you're the client that is kind of blown out their credit and you're on the other side of that, reestablish is going to be important. And it really doesn't matter if you restore a card, a secured card, a credit builder card, but you need to reestablish. And people are oftentimes shocked by that. When we do their analysis, they're like, well, wait, I got 6 credit cards and I let go 4 years ago. Who's going to give me a credit card? Well, there's plenty, so there's plenty of just credit builder credit cards that don't even pull your credit. They don't even work like real credit cards, but they post your credit like a credit card, right? So they're out there to help people that are trying to reestablish credit. So
and Justin, just to clarify for folks out there, are those like the secured cards and things like that people hear about, or is that even different still?
They're not. Okay. So they're just meant to rebuild credit. They're credit builder credit cards. They don't pull your credit. One of the cards actually runs through your checking account. You get a card. that runs through your checking account, and it pulls the money as you pull the money, but it shows up on your credit as a credit card, right?
Interesting.
There's some, online stores and things that are like, they're not you're not going to want to shop there a lot, but you get to reestablish credit.
Right. Okay.
So there's, if the client is kind of on that side of the spectrum, there's a solution there too. A lot of people think they're so far gone, there's not a solution. There's a solution for just about everybody, provided that they're situated to where they're able to do some things that they may be uncomfortable doing, like getting a credit card they really don't need, right?
Yeah.
But it's going to help grow and augment the size of their scores. So the credit scoring algorithm across the board, all the different variations and generations, they want credit cards, at least one.
Yeah.
Possibly 2 credit cards. Then you've probably heard keep it under a certain threshold. If you've got $1,000 limit, stay under that 30% limit or 30%, ratio.
Right.
So don't spend more than $300. It's actually under 9%. That's going to be your best kind of area to be in. But over 30%, you actually get hit with what's called a major derogatory, which means that, you're kind of slammed for being over 30%, but it's a dynamic number. People don't realize this, is that it changes whenever you pay down your credit cards. So the trick is before you go to apply for something, make sure those metrics look correct.
Yeah.
And then give it 30 days to update with the bureaus. So pay off your credit cards, give it 30 days to update with the bureaus, and then you'll get your car or go get your mortgage or go, but
Sure.
What you do before you apply, if you max out your credit cards, it really doesn't matter because it'll rebound as soon as you pay them back down.
Okay. And that will happen pretty quickly. Then those tend to respond pretty quickly if you've got it.
Days.
Okay. So next time it reports that score can change again. Just that.
It'll jump up, right?
Yeah.
Now they have a new FICO generation score that just came out. It's called FICO 10, and they use what's called trended data. And I'm a bit obsessed with that scoring algorithm. I think it's a really good algorithm. And what it does is it takes, let's say we have person A and person B, they have the exact same data on all 3 credit bureaus, which is, would never happen.
Right.
But let's say they do. And, person A is actually, over the last 24 months, is taking on debt, and person B is actually paying off debt. So they have the exact same data. So the scoring algorithms that we use now would actually would quantify them the same.
Okay.
Because at any particular time, they, let's say their utilization was, the same.
Right.
But the truth is that, over the last 24 months, somebody's showing progress on paying things down. So FICO 10 is actually going to take into account that trended data, the last 24 months of payment history, and going to build out a score based on that, which, I think is a really good way to go.
Yeah. Which makes sense. Yeah.
Absolutely makes sense. But right now it didn't work that way. So you could easily just max out your credit cards, and then before you go to apply for something, pay everything down, and you get a massive spike in score. Is that really who you are?
Right. Yeah.
Maybe.
Yeah. Not using logic in there, but we find a lot of that these days, unfortunately, where logic's not being used. And that'll lead us into this next point. Kind of the last thing I wanted to talk about before we start to wrap things up there is, you and I sometimes we'll just talk about, the economy in general and business and what's going on out there. And, this affects and touches both of our worlds right now. Just last week or the week before here as we're recording, we had the bank failures, Silicon Valley Bank. This last weekend, Credit Suisse over in Europe, we saw them, First Republic's teetering right now. By the time this comes out, might know what's going on there. Fed's meeting, rates been going down. Yeah. Go figure. Going back to that, none of it makes logical sense. So give the folks, what's your general feeling overall? Before we started recording, you and I were just touching a little bit about what's going on in markets and stuff. What are you seeing? Because you're kind of in this world, like you said, you're a finance guy, you're in the markets, you're dealing with people's credit and seeing with everything going on right now, with rates going up and, bank failures and things. What's your overall sense as to what we've got going on right now?
I think it's a very odd time. One of the biggest things, we talked about this, the concern with the Fed when they hike rates, especially when they do it aggressively, they almost always break something, right? And the talk was they weren't going to break something this time. We were going to have a soft landing. People are still talking about a soft landing. Like we passed that 2 weeks ago.
I agree. Yeah, we're past the soft landing part.
That already happened. So, so the Fed did break something, right? They broke a few banks, right? And I was reading data the other day that there was like 187 banks that were all had liquidity issues.
Oh, wow.
There's they don't mind playing. The Fed doesn't mind playing hardball until the banking system seems like it just might fail. Then all of a sudden they won't disclose information. They start talking in lofty language. They're not going to talk about bank failures, So when the Fed meets, I think they meet today, right? And tomorrow. I suspect that their language is going to be a lot softer. I suspect that they're not going to raise, half a percentage point, probably a quarter. Probably don't want to at all, but they have to because they commit to it now.
Yeah, I think that that reputation risk is there, and so I agree with you. I think they're going to be doing that quarter.
Right now, on the brink of financial banking collapse, they probably shouldn't at all. But so I was watching the other day. I was doing some research, and I was looking at the amount of money that banks have liquid now, where it went from like, here to like, a lot. And then the Fed is backstopped, I think, $2 trillion worth of, funds that they've backstopped for banks that need liquidity. So, we went from this situation, probably a really bad collapse, I think, in 2008. Because once the contagion happens, it's a mess. To having a situation where they have unlimited funds, and likely if a bank fails, anything over the 250 mark for FDIC is probably going to get backstopped also. So we went from, just 2 weeks ago, we went from the brink of collapse to the markets absolutely taking off today.
Yeah. Which, like we said, which is crazy because here you are, like we said, we're talking about banks collapsing, the Fed potentially, and this is just my opinion, but that's probably going to be their last hike here because, like you said, stuff's starting to break. It's starting to get to that point. And, you've got the Treasury Secretary talking about, these emergency situations to back depositors all the way up. And like you said, the markets are taking off. And so, these are interesting and crazy times that we live in. But I know certainly, for our industry, what we've noticed, especially here in these last couple of years with all the craziness, everything now is moving so much faster, and so, real estate used to be seen as something where it was much more slowly, adjusting, and 6 months to feel something in the market, and, buyers and sellers markets were at certain inventory levels, and all of that has just contracted. And so everything now is moving and changing so much quicker. So, people really have to be, somewhat on top of these. Maybe they're not into things as much as you or I are, but I think people today just really need to at least have some basic understanding and some basic things that are out there. And so it's interesting, guys. Like we'll keep trying to update you guys on the major points. I know Justin's always looking at what's going on there as well. And on the credit side, definitely has some helpful tips. I know you have your YouTube channel where you put out some tips and videos and information there. Tell folks a little bit about kind of what kind of stuff can they expect on there.
Yeah, so my YouTube channel, I just started last year. I try to put out at least a video a week, and anybody who's created content knows that's terribly time consuming. So the whole point of the channel is to just answer questions people always ask. So if you go through, you're going to see a lot of stuff, a lot of questions, and these are questions that they're asking, and these are questions that I try to answer in the most honest way that I can, because as I mentioned before, one of the reasons why I started the YouTube channel and even really this company was to combat some of that really bad information out there. The truth isn't glamorous, unfortunately, but it's the truth, right. So it works well.
Yeah. And that's key. That's like you said, it's accurate. It's the truth. Well, Justin, I mean, we could go on talking about some of this stuff for an hour. I appreciate you joining us today. There's a lot of good info I think that folks just have, and we're just scratching the surface, guys, on some of this credit stuff and certainly everything else that's going on out there. So if folks do need some help, if we've got lenders out there that want to talk to you about, working with somebody better or, individuals, what's the best way for people to get in touch with you?
So you can go to my website, creativecreditsolutions.net. So that's creative, creativecreditsolutionsPlural.net. That's probably the best way. There's an 800 number there you can call. Or you can email me at justin@creativecreditsolutions.net, and I'll respond directly to you. But we do specialize in the real estate market. So if you've got, buyers that are struggling and need some help, then we can certainly, try to figure out their situation with you.
Perfect. So yeah, guys, realtors out there or anybody listening, if you guys want to talk to Justin, definitely recommend doing that. Like I said, he has helped me out personally in the past. So I know that him and his company do good work. We will put the links, guys, in the notes, both to the website and to the YouTube channel. So you guys can click on there and find Justin that way. And if you guys have any questions for us, remember, it's questions@kpeliteaz.com. Follow us on all the socials at the KP Elite. And Justin, we appreciate you joining us today. It's been a fun conversation, and we'll definitely keep in touch, my friend.
All right, man. Thanks.
Perfect. Thank you, guys. We'll see you guys next week.